Good evening, ladies and gentlemen. Welcome to the Somany Ceramics Limited Q3 FY23 earnings conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the management's opening remarks. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Navin Agrawal, Head Institutional Equities at SKP Securities Limited. Thank you, and over to you, sir.
Good afternoon, ladies and gentlemen. On behalf of Somany Ceramics Limited and SKP Securities, it's my pleasure to welcome you to this financial results conference call. We have with us Mr. Abhishek Somany, Managing Director, along with Mr. Shailesh Raj Kedawat, CFO, and Mr. Kumar Sunit, AGM Finance. We'll have the opening remarks from Mr. Somany, followed by a Q&A session. Thank you, and over to you, Abhishek.
Thank you so much. Welcome, ladies and gentlemen, to the earnings call of FY23 Q3. We've had a muted quarter. Our sales stood at 612 crores and consolidated 618 crores. Tiles volume increased by 3.7% to 16.15 million square meters in this quarter. EBITDA was under pressure, and as a result, the PBT and PAT also was under pressure. We have done a tile segment revenue. If I look at it, we've done about 38% of sales in ceramics, 29% of sales in PVT, and 33% of sales in GVT. Bathware, we had a very nominal growth, very small growth of just 1% between last year and this year. However, over the year, we've grown at about 20%. The tiles volume also, on the 9 months, we've grown at about 11%. The pressures on the EBITDA was on 3 accounts. One was that it was a muted sales. There was a muted quarter in terms of volume and value of sales. On a normal course, this quarter 3, would have been a much better quarter than from a historical point of view. Coupled with the muted demand outlook in this quarter, we also had pressures of sales where there was an extra discounting which was done to get the material in the market. There was no reduction in prices per se, but we discounted a couple of % more to put the material in the market. Other than that, the gas prices were also tapering off, but were still fairly high in this quarter. And we had festivities all coupled together in this quarter. And we also had pressures of the various Morbi players which were selling at whatever price need be to get their cash flows in order. So on one hand, it was muted demand. On the other hand, it was the fuel prices. And on the third hand, it was the festivities, which was the problem from a market standpoint. From our standpoint, we gave an extra couple of % of discount in the market, and also we had a little extra advertising spend than normally we would do in Q1 and Q2. So all put together, this resulted in a lower EBITDA margin, largely impacted by the fuel. If I come to the fuel cost, is an overall fuel cost for about 59-60 rupees. It was slightly down over Q2 FY23, about 4 to 5 rupees lower overall than the FY23 Q2. So later, if somebody would need, we could give you the breakup of Kasar, Morbi and South plants, and also the West plants. The average capacity utilization in Q3 was 87% in tiles, about 67% in sanitary ware, and about 62% in faucets. The brand spend was a little up, like I said. Normally we do 2.5, 2.6%. This was a little above 3%. The network did very well. We've already added about 225 net dealers in the 9-month period. A large part of it has come in Q2 and Q3. Other than that, things were very normal, apart from what we've just discussed. Another thing I would like to mention here is that going forward, we are seeing tapered gas prices which are coming off, and we are expecting the export to pick up in the Morbi region, due to which there would be lower pressure on the Indian market. So these were the highlights for our results of Q3. I would now like the floor to be open to Q&As. Thank you very much.
Thank you very much. We will now begin the question and answer session. Each participant is requested to limit herself to a maximum of 2 questions. Time permitting, we shall revert for any further questions that you may have which remain unanswered. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1. The first question is from the line of Viraj Mehta from Equirus PMS. Please go ahead.
Yeah, hello Abhishek. My first question is regarding exports. Now, the competitive intensity in the domestic market seems to be much higher because the export volumes seem to be suffering. Do you see any change in that in near to medium term? Hello?
Hello. Sorry, it wasn't you. I'm saying the export volume has not gone down. It has in fact gone up, but it's not gone up in the tune of the manufacturing setup which came up in Morbi in the last 1 year. So the export volume has gone up from about 1,100 crore rupees to approximately 1,400 crore rupees a month. And this is expected to grow up even further, closer to approximately 1,500-1,600 crore rupees a month. So definitely this has picked steam, and this is lowering the pressure on the Indian domestic front. So I think with the freight rates now going down, exports seem to be clearly picking up. It was just that November, December, mostly in Europe, the destocking happens looking at Christmas, and therefore they come back again alive after holidays. So that was a lag effect, but otherwise exports has picked up and it's only going up further.
Sure. When I talk to some of the players, for them the fuel prices have gone down from 53-54 rupees in Q2. In Q3, the expectation is 46-47 in Q4. We are already at a higher range of that. We are like at 58-59, as you said. What kind of reduction do you see this quarter?
So the 54, 53 is the rate only for the northern plants, I would think. Nowhere else. Everywhere else the rate is 59, and this has reduced. They're very clear. This is reduced from January onwards. So if you look at the northern plant, it is reduced to approximately 50 rupees. And the western plant, it has reduced to slightly under 50 rupees because GSPCL has slashed its rate. And south plant still remains around 60 rupees. And this is for pretty much the industry. There could be 1 or 2 players who have other baskets also, like the Henry Hub and the JCC. Maybe their rates only for the north could be 2-3 rupees lower, but that's it.
But so for the combined entity, do we look at a 6-7% reduction this quarter?
Yes, I would think so. It already has happened, na? From January, I am saying that the north rate has gone down from the 55, 56 to about 50 rupees. So that's about 10%. And west rate has gone down even further. South hasn't come off as much. South was at 62, 63, and that's gone down to around 60, 59, 60.
Right.
The overall weighted average, it will go down by 6-7% or more.
Sure. And my last question would be regarding market share. This year we have grown significantly better than the market because we know how market has grown, and Somany has definitely grown faster than the market. What is your aspiration for next year? Let's say if the market leader says the market is to grow at 11-12%, what will be your aspiration of growth in volumes if that were to happen?
So I don't think the market is going to grow at 11-12% domestically. That's a correction. The tile industry may grow at that much. Yeah, total sure, but let's not talk of total because all the branded players don't export, right? So where I'm not competing, what's the point of really looking at any market share? So from an export point of view, if I double my export also, it's not going to move the needle for me in terms of total revenue. It's such a low base. You understand what I mean? Sure. So let's talk of basically the domestic. In the domestic, we're fairly confident of again achieving double-digit figures, decent double-digit figures. So I won't say it would be the 20% or the figures, but it would be on the mid-teens, higher teens is what something we could think of in value terms.
Thank you. Mr. Mehta, may we request that you return to the question queue for follow-up questions. Thank you. We'll take the next question from the line of Ritesh Shah from Investec. Please go ahead. Mr. Ritesh Shah, your line is in talk mode. Please go ahead with your question. Mr. Shah, please unmute your line from your side if muted. As there is no response from the current participant, we'll move on to the next question from the line of Sujit Jain, ASK Investment Managers. Please go ahead.
Just one question, for
Mr. Jain, your audio is breaking.
Sorry, I can't hear you.
Your question.
Can you hear me now? Loud and clear?
Yes. Loud and clear.
Yeah. So I just want to ask you how much for you would be demand which is coming from replacement, just to have a general sense, and how much would be from new projects?
Sir, it's always been very difficult to figure out that, but our best guess scenario is the replacement demand in the tile industry, not for us, but the tile industry per se is between 15 and 20%.
And and would you be more urban centric overall in your distribution?
Urban, yes, but not tier 1 in tier 2 towns. Our large part of our sales, 75% and more, or you can say 75% is coming from tier 3, 4, 5 towns, maybe some bit of tier 2. So urban, yes, I don't think tile has really gone very, very rural. That's something to look forward to in the future. As of now, we would be in concrete towns and not in the hut towns. So that's what we mean by urban and rural.
Get that. So similar percentages would be for you as well, most likely in terms of replacement versus new project, right?
Yes, sir. So the second part of the question, which was urban and the tier 2, tier 3, tier 4, that was for Somany Ceramics. That was not for the tile industry. We are very in tier 2, tier 3, but in as far as the replacement, that's an industry phenomena which I told you, which is between 15 and 20%.
And number of distributors for you as things stand today?
So we have approximately, on record, we have about 3,900 or 4,000 dealers. But what we build to is approximately 2,400 to 2,500. And when we build to, that means there's a regular billing with these parties.
And one last question. While we've seen pickup in real estate, there is some slowdown in terms of bookings of, the numbers that real estate companies give out. Is any hampering in terms of real estate demand because of that going forward?
I think the real estate has finally come back after a 10-year lull, and if I see across India, there's been new projects which are launched. And in real estate, we are the last to be consumed, so therefore, whatever project gets launched today, we only come into the picture or in a sales situation 18 months from inception, 18 to 24 months. And real estate is a large play for a lot of the Morbi players. So we will see a lot more of the Morbi players supplying to the real estate guys.
One last question. I joined the call a little late, so pardon me if this is a repetitive question. In terms of your guidance, in terms of volumes, and over medium term as well?
So medium term is something which it's already on Q4 really. So, but for next year we are guiding a mid-teen growth.
And you think you can continue that over a 3-year time frame?
Depends on how quickly we grow next year. I don't think I can predict 3 years, and again the base would have increased. But I do believe that it would be in double digits, obviously teens, not double digits as in above 20, but obviously in teens we should be able to do at least for the next 24 months, and then I think we are on a call every quarter, so I would recalibrate that for you. But next year at least we are very sure of mid-teen.
Thank you. Mr. Jain, may we request that you return to the question queue for follow-up questions. Thank you. The next question is from the line of Ritesh Shah from Investec. Please go ahead.
Hi. Am I audible?
Yes, absolutely.
Yep. Hi, sir. Sir, couple of questions. First is, in your initial remarks, you indicated giving a certain percentage point discounts to drive volumes. Just wanted to understand your thought process from a perspective of price elasticity demand. We are a solid brand. We have pan-India distribution. So how is it that you take a call on a certain percentage of discounts to actually push volumes? I would like to have your thoughts over here.
Not really. Discounts was a terminology I used. They generally incentivize the dealer. So you generally put in schemes to incentivize the dealer to pick up material in a muted market. So there's been no price reduction, mind you. There's been no price reduction. It is just that we've given schemes. So now schemes goes in forms which could be foreign travel schemes, it could be the white goods schemes, it could be credit notes given to the dealer. So all encompassing, it's been approximately a 1.2% extra discounting which we've done to incentivize the dealer to pick up material in a muted market.
That's helpful. But sir, when we do this, what is the competition that we look at? Is it the organized sector or is it Morbi?
Always the organized sector. We have a 20 to 25% difference between us and the Morbi players. So if we start looking at that, then there's no bottom.
Correct. Perfect. That's very useful. Sir, my second question is, can you detail on our fuel mix? Say LPG, long-term, medium-term contracts, biofuel, if at all there is any mix on a quarter-on-quarter basis, that would be very useful.
So, last quarter we ran a reasonable amount of plants, approximately 60% of our plants on LPG, right? And biofuel is only used for our spray dryers, nowhere else. That's been used from inception. So we continue to use that. In the northern plants, we used to use pre the NGT orders of 2 years ago, we used to use coal in our spray dryers in a chain stock. Now, since the last 2 years, we've stopped using coal and we've had to move to biofuel due to the NGT orders. So in the north, it is all biofuel to run spray dryers, and so is the case in most of our other plants. But as far as our kilns is concerned, which is the 85% of our energy goes into firing our kilns, 80% of our energy goes into firing our kilns. That we ran 60%, once again I would repeat, of our total production on LPG last quarter. As we speak, the LPG is virtually out because the gas prices have come down and LPG generally goes up in the winter months. That's been the practice. We did not know that because we've never used LPG earlier. But right now as we speak, I think about 10 to 15% of our plants are running on LPG and the rest of the plants have moved to natural gas because natural gas has become at par or cheaper than LPG. And going forward, the way it is looking, I think in the month of February and March, most of the plants will go on natural gas until LPG comes down further in the month of April and May, and this is completely fungible. So therefore, if LPG comes down a substantial amount than gas, we would move back to LPG. It takes only 6-8 hours for us to move.
Wonderful. Sir, last question. How should one look at the pricing trends incrementally? So there is cost deflation. Do you think we'll be able to maintain prices, or how should we look at this?
Yeah. So what has happened is that in Q2 end and Q3, pretty much the whole amount of the Q3, Morbi had already moved to LPG, which means that the reduction in gas price which we are seeing in LNG, especially in the Morbi area, that was already factored in because it was 60 rupees. LPG was then costing them 51, 52 rupees. That 51, 52 has gone down to about 49. So it's not a big difference. So this was already factored in the pricing. Therefore, any further in our northern plant and our southern plant, that is something we would be able to keep because Morbi's pricing has already factored in about 50 rupees or 49 rupees a standard cubic meter of gas. In the entire quarter, it has already happened. So I don't see any other further price corrections going forward because gas hasn't fallen under that price.
Thank you. Mr. Shah, may we request that you return to the question queue for follow-up questions. The next question is from the line of Nikhil Agrawal from VT Capital. Please go ahead.
Yes. Good evening, sir, and thank you for the opportunity. So I was hearing there was a rumor that ADD on ties on Indian ties from Saudi Arabia is about to be removed.
Interrupt you, Mr. Agrawal. Please use the handset mode. The audio is
Okay, sure. Hello, is it better now?
Yes.
Yeah. So, sir, I was hearing that Saudi Arabia, they're planning to remove the ADD anti-dumping duty on Indian ties. So, just wanted to know, do you have anything on that? And how much would it benefit the organized players? If you could give some roundabout figure or something.
So organized players never really exported to the Saudi when the anti-dumping was not there and when the anti-dumping was there. So it's a Morbi play. So we don't get affected either ways. But for India Inc., from a tile perspective, it would be a great advantage if this has to go. And you're very right, even we've heard the same, that they're planning to remove it. So UAE has taken the lead. They have already removed the anti-dumping as we speak.
Okay. So actually, I meant that since if the anti-dumping is removed, so the Morbi players, they start exporting more.
Yeah.
So
absolutely.
I mean, so indirectly it would benefit the organized players, right?
That's right.
Okay. And anything from US as well? Are they planning to remove the anti-dumping duty on? They're India, they don't have, but on China or anything?
No, anti-dumping duties are generally levied for 5 years, and it's a definitive anti-dumping duty, of which only a year or maybe 15 months is over. It was put last January, if I'm not mistaken, the anti-dumping on China. So India has a good headroom. In fact, as we speak, the single largest export to a particular country has now become the US, which earlier used to be the Saudi.
Okay. So when is the anti-dumping duty expected to expire on on Chinese tiles in the US?
I just said 5 years, only 15 months has got over.
Okay. I didn't get that. Sorry. And so just one more question, regarding biofuels. So you said that our factories won't shift to biofuels going forward.
No, biofuel you can only use for spray dryers. You cannot use biofuel even if you want to in kilns. So kilns are only fungible between propane, LPG and natural gas. The spray dryers are fungible between coal, biofuel, various kinds of biofuel and gas. So whichever is cheaper, we use in most of the plants. In the north, it is fungible, but I can't use coal. So in the northern plants, it is fungible between gas and biofuel.
Okay. Got it, sir. That's it from me. Thank you so much.
Thank you. The next question is from the line of Alisha Mahavla from Envision Capital. Please go ahead.
Hi, sir. Good evening. Thank you for the opportunity. Just wanted to understand the increase in finance cost sequentially. The number has gone up quite substantially.
Yeah, I would let Shailesh take that question. Finance cost.
There's hardly any increase in finance cost. It remains the same quarter on quarter.
It's 10 crore has become 12 crores, which was 7 crores in the first quarter, and similar amount in Q3 of last year.
Okay. You're referring to the console number. There are some additional loads. There are some additional projects which we have put. Right. There is a new project which has come. So finance cost is on account of that project.
We've also seen sharp. Hello.
Yeah.
Yeah. We've also seen sharp increase in inventory, 9-month number versus March of 22.
There's a muted demand, I think. Inventory increases across the industry. You would see it across the industry. There's a muted demand, and we have ensured that our production units are not shut down. We have continued running them at an optimal capacity, right? Because we believe that demand is going to go up.
Yeah, so the manufacturing has run at 87% capacity, like I mentioned. So to that extent, the October, November, December were a muted demand, and again we're getting into Q4, so we don't want to be in a situation where we don't have enough tiles. So there's been a little bit of a mismatch last quarter of approximately 4 to 5 days. If you see historically, our inventories in Q4 would have been approximately 50-day level, which is currently at the 60-62 day level. So maybe 4-5 days was a mismatch. The rest of it is on the account of pure muted demand.
By when do we expect this to normalize? Because even for next year, we're saying in value terms mid-teens growth, which means that the volume growth will be slightly lower. And the build-up of inventory looks kind of sharp from 275 to 400 odd is the number in the presentation on consolidation.
Even this year, over last year's square meterage, we'll put in nothing less than 6-7 million square meters extra this year in the market. So next year, if you put in another 6-7 million, so inventory is very easy to control. You lower your capacity utilization, you can control the inventory. So that's very simple to do, but again, that eases the pressure on sales and marketing.
Okay. Any guidance on the margins for when?
Just to clarify, beyond the point, it's a very voluminous material. So beyond the point, I can't keep inventory. So at the end of the day, the plants do go into shutdown like I did in COVID times, because you can't hold more than so. It's only this much inventory you can hold in the plant.
Sure, understood. Any guidance on when the margins can go back to the double digits that we used to do for the previous 2 years, and the aspiration was to improve?
So I don't think I can make any forward-looking statements there, because there's a serious amount of volatility in the gas pricing. But I do believe that if the gas pricing remains the same and we are able to push in the amount of value volume we are planning to, obviously this would keep increasing a couple of 100 basis points over time. But I can't make any forward-looking statement as to when this would happen, owing to the extreme volatility in the gas pricing.
But with gas now at 53, 54 odd rupees, like you said, and assuming it stays at this, can we expect sequential margin improvement?
Sure.
If it stays at this 53, 54?
I would suppose that it would only keep going down month on month, hopefully. So yeah, we can assume that.
Okay, so sequentially we can, though it will take some time. Got it. Great. Thank you.
Thank you.
Thank you. The next question is from the line of Dhwanil Desai from Turtle Capital. Please go ahead.
Good evening. So my first question is, the market leader in the call was indicating that the savings which the industry may get from the lower gas cost may be passed on as a discounting. So are we likely to follow that, or will we have to follow to ensure that we get the volume growth? Any sense on that?
What did they say? I'm sorry, I missed you. You were not clear that time.
Yeah, so essentially market leader was saying that some of the benefits of a lower gas cost will be passed on as a higher discounting. So I mean, are we likely to follow that, or we think that we'll be able to hold on to our pricing and realization?
So I think they were at a higher cost than us. So I would think that they would be right in saying that in terms of south and west, because south and west we are at the same gas pricing. But any advantage which flows through in the north, because north our gas pricing is slightly higher than what we are in the west plant. Therefore, we should be able to get some benefits from the northern plant. In the southern plants, we are at a much higher gas price than in the west plant. So from that point of view, we are anyway having to discount it further, because we're producing at a higher cost, and the material which is coming in at Morbi is coming at a lower cost because the gas pricing is lower. So until the south gas price also doesn't start correcting sharply, there we will have to discount. In the west, it's a pass-through any which way, but in the north, I do not think we would have that kind of pressure. We should be able to retain some margins after lowering of gas price.
Sure. And second question is, you indicated that next year we are expecting, mid-teen kind of a volume growth. And whatever that we hear from various industry players is that even, in the current quarter, the demand environment is quite muted. So what gives you that confidence that next year we'll be able to, get that mid-teen kind of a volume growth?
Overall. So I think what gives me that confidence for the demand to be picking up is the festivities which happened in October all bunched together is behind us, and I think there was an extreme winter which is also behind us. And another thing is that a lot of the focus had moved as the economy opening up, especially with weddings, marriages, etc. That also is something which is behind us. And coupled with that, we are seeing a revival in the real estate. Coupled with that, we've seen that the inflation has also peaked out. So people were waiting for the earlier gentleman had asked that there's muted demand in terms of real estate being booked. Obviously, because the real estate gets hit when the interest rates go up. I think that interest rate cycle also we will see in the next couple of quarters start going down. So buyers would start coming in again. So overall, I think we should be in a much better position as what we were this year. And this year there was another major issue that the dealer was buying only as much as he wanted because gas prices were moving up and down pretty much on a 15-day basis. That kind of volatility I at least haven't seen in the 25 years of my career. If that volatility is not there, the dealer is also that much more secure when he picks up the stock. So all of these combined, I think we're definitely looking at a much better next few quarters. However, at the same time, I do believe that India, we are looking at the global scenario, at least for the next 1 year, rural India and a lot of the other parts of India are going to be under pressure. There is clear indications of money market being tight. However, our receivables have been very good, but generally money market is tight. Secondary sales are not happening. So all those do affect, but those things will start getting eased out because last year has been a fairly exception year in terms of pretty much all commodity prices going through sky high pricing. So those are the indicators which we feel that the worst is over and things can only get better from now, unless otherwise another war happens.
Just to follow up on that, so I mean, do you think that in this entire thesis that you have that next year we'll be able to grow at mid-teen kind of volume growth? Morbi holds the wild card in terms of exports. If that doesn't happen as per plan, we may have to relook at those assumptions.
Sorry?
The Morbi exports, as if that doesn't pick up as expected, then will we have to relook at those 15% volume growth assumptions?
No, I don't think so, because this year also we've grown reasonably well. And I don't think we can be as pessimistic as that, because while China has an anti-dumping pretty much in the world, there is no reason for Morbi not to go up. Over there also we are seeing that freight rates have absolutely gone berserk last year, which have come off in the last 3 months. Every month on month it has started going down. There is no reason for freight rates to go up any further. So from that point of view, there is no reason for Morbi not to export. Unless and otherwise there is an anti-dumping initiated in India, on India, which currently that Ek Talwar Jhul Thi of Europe, that also is gone away. Europe has only levied a 6% anti-dumping. So we're very safe there. So from that point of view, I don't see any reason for India not to do exports.
Got it. Thank you. That was very helpful.
Thank you.
Thank you. The next question is from the line of Gunit Singh from Counter Cyclical Investments. Please go ahead.
Hi, I would just like to get some sense on the advertisement and sales promotion expense for the 9 months and also for the last year, financial year 2022.
Last year we did about 46, 47 crore rupees. This year we'll do close to about 58 to 60 crore rupees.
All right. Is the spend also related to the muted demand that we're seeing? Or is it just a routine increase?
As a percentage, obviously, because we didn't want to take off anything off the table from advertising because this is a long-term investment. But as a percentage, obviously, if you would have put in 50 more crore rupees of revenue in quarter 3, my percentage would have been pretty much okay. So somewhere indirectly, directly, you're right. It does have an effect. The muted demand has an effect.
All right, that's it from me, sir. Thank you.
Thank you. The next question is from the line of Achal Lohade from JM Financial. Please go ahead.
Yeah, good evening. My question was with respect to A&P. Can you help us with the 3Q spend in 3Q FY23 and YOY last year, same quarter?
Yeah, so in Q3 it's 18 crore rupee current quarter, and in 9 months we reached to 40 crore plus, and we are expected to reach to a level of 58-60 crore rupee for the year. So
in quarter last year?
So our spend is much higher in the current quarter, Q3. The corresponding Q3 was lower base for various reasons. So that was on a lower number around 10-12 crore rupee, Q3 last year.
And 9 months?
9 months last year was approximately 25-27 crore.
Got it. With respect to, the demand part of it, Abhishek ji, you mentioned that basically the hope is driven by the inflation and interest rates and the macro part of it, if I hear you right. And exports are expected to remain robust, right? So from pricing scenario perspective, I know it could be a repetitive question, but is it fair to say then, the further pricing pressure is unlikely from Morbi, in terms of our realization?
So, currently, yes, you're right. Because like I've mentioned that they had already factored in a lower gas price because they were running on LPG. Therefore, they've only moved from LPG to natural gas because it's an easier fuel to handle. But the pricing really hasn't changed for them. So currently, there is no reason for them to reduce pricing. The other reason they were reducing pricing was basically, so the problem is not in the top 20 Morbi players. The problem was with at the bottom 400-500 Morbi players who were basically so strapped for paying GST, paying for gas, paying for salaries. They were willing to sell the tiles at any price, even at a loss, to keep running their cash flows. It was devil in the deep sea. One side it was shutting the plant and X amount of loss. One side it was discounting it and reducing the loss. So I think that was the phenomena happening. And as you very rightly know that in Morbi, everything happens on two accounts, on cash and on check. So I think they had never envisaged that the gas pricing would go so high. So all their books had gone completely haywire from that point of view, and therefore they started selling. So there's a new terminology in Morbi. There's a separate pricing which is called a one-time pricing. So that's what really played spoilsport. I think that seems to be over us because the gas volatility is kind of behind us. I hope so.
Okay. And, with respect to channel inventory, how do you see, has the channel already stocked up, as Morbi has been pushing, and if the other peers have also pushed?
No, I think the month-end pushes are always there, but I don't think the channel is anywhere close to where it used to be in terms of stocking, for two reasons. A, it's been very, very early in the days where gas prices have started coming down. So they are anyway were very skeptical of gas prices going up or going down. Now that is going down, they are always scared that tomorrow the prices may come off even more. They're not sure how much the gas prices would come down. They're not sure of who was using LPG and who was using LNG. So I think they are skeptical and they are tentative to not stock too much. and then having a problem of next month lifting to be at a lower price, and their previous month would have been, money stuck. So number one is that. Number two is that great indicator is that my receivable cycle is not under pressure, touch wood. My receivable has only become better. So on one side, I'm saying that it's muted demand and money market is tight, but on the other side, my receivable cycle is the same or slightly better, which is a clear indicator that the dealer is buying only as much as he can do in secondary sale. So he's not stocking too much. The minute the dealer started stocking, that's when you start seeing the receivable cycle deteriorating. So these are the two indicators, which is with a reasonable amount of confidence, I can say that the dealers are not hugely stocked. Obviously, month end they get a little extra stock, but not hugely stocked like how it used to be earlier.
Got it. If you could help us with the 9 months, what is the cash flow from operation and the capex number, consolidated level?
Sure. Sunit, you want to take that?
Yeah. So lastly, actually it is in tandem to the cash profit generated by the consolidated P&L, because there is no major movement as far as working capital cash flow is concerned. In fact, our almost 100 crore rupees is locked in additional inventory at a consolidated level. So adjusting that, we are at the similar level of cash profit, similar level of cash flow generated from the cash profit of the P&L.
Any numbers, Sunit, you could help us with?
It's not readily available in front of me. We can connect offline.
Sure. And just a last question, if I may, with respect to capex, how do we look at what capacity addition, where, and what kind of capex we would look at for FY24-25?
Yeah. So as you know, the Somany Max plant, which is coming up in Morbi, at a cost of approximately 170 crores. That is the only capex which is there. Partly it has already been done. Some part of it is still to be done in the next year. So that is one capex which we are doing. There could be obviously routine capexes around the existing system. And as we have just announced, we are looking at setting up a JV. We're exploring to look up to set up a JV in Nepal, which I think I would be in a better position to tell you exactly what the capex needs would be and how that would be structured, maybe in the next call.
Got it. Thank you and wish you all the best.
Thank you.
Thank you. The next question is from the line of Keshav Lahoti from HDFC Securities. Please go ahead.
Hi. Thank you for the opportunity. I just want to understand, why have you increased the ad spend in this tough quarter of quarter 3 when fuel prices were already high? What was the idea behind this?
No, it's a long-term investment which we do, and anyway, generally in the quarter 3, quarter 4 ad spends are larger, because we typically in the tile industry start advertising after the clutter of the Diwali season. So a little part of advertising happens, in that window which we get after the rains and before the Diwali season, and then most of the advertising kicks in after the Diwali season. So it generally bloats up, if you've seen historically, also in quarter 3 and quarter 4.
Okay, got it. And what sort of margin you would be looking in next quarter, and whether the dealer discounts will also further increase in quarter 4 as fuel prices are coming down?
No, the dealer discount is not related with fuel prices. The dealer discount and schemes are all generally related to how the market is. So the way it is looking is not superb, the market. So maybe a little bit of discounting continues in this quarter to push in that extra material. We're all also sitting on a decent amount of inventory, and capacity utilization is always number one on our card. So to that extent, dealer discounting may happen a little bit. Not discounting in terms of cash discounting, but probably in terms of schemes and incentives. On the other hand, as far as margins are concerned, it obviously would be better than the quarter 3, but how much better, it would only depend on how much the dealer discounting it, how the market performs, and mostly to do with fuel, because fuel goes down, but we don't have 100% BI as to, we're not sure exactly how GAIL really bills are normally on a 3-month moving average of the Brent, but there is a little bit of a slip between the lip and the cup. So as and when we would know, but yes, definitely margins would be better. There would be better volume in the quarter, and also there would be slightly better margins if the gas prices remains the same.
Okay. Got it. Although we have discussed the fuel prices, is it possible for you to share region-wise trend for Q3 fuel prices?
Sorry?
Region-wise trend of fuel prices for Q3, North, West, and South.
Mr. Lahoti, sir, please use the handset mode.
You want region-wise fuel price?
No, I think audio is not.
I can't hear you.
Hello.
Mr. Lahoti,
Yeah, I just want region-wise trend of fuel prices.
Okay. So in the north it is approximately 57 rupees. In Q3, in the Morbi area it was 62 rupees, and in the south it was 61 rupees. Now as we speak, the northern plant from 57 has gone down to approximately 52 rupees, and the Morbi area from 63 has gone down to 50 rupees, and the south area has remained the same.
Okay, so south is at 60 right now. Perfect. Hello?
Yeah.
Yeah, so south was 61 in Q3, you said. Perfect.
Yes. And it remains the same, plus or minus 50 paisa also rupee.
Got it. One last question from my side. So there is, talks about Morbi going for further 1 month shutdown. So what is the scenario and what is your take on this, whether this will materialize or not?
Okay, that's news to me. I haven't heard it. And when were they talking about the shutdown, if whatever you've heard?
So we just heard a few weeks back.
And when? What was the timing of that? What were they saying?
So we heard there is a extra stock in Morbi, so possibly they might take a further 1 month type of a shutdown to lower the inventory levels.
I'll find out. First time I'm hearing this in the last couple of months.
Okay. Thank you.
Thank you.
Thank you. The next question is from the line of Karan Bhatelia from Asian Market Securities. Please.
Hi, sir. Thank you for the opportunity. Sir, how do we see our bathware portfolio shaping up, in terms of revenue and in terms of margins as well for next 2 years?
Yeah, so revenue, we were expecting a much better growth this year. We should be able to manage a plus 20% growth for sure. But the margins are flat than last year. It's at about 12-13% EBITDA levels, and it continues to be the same. Next year, we would be focusing a lot more on bathware, so we should be able to grow at the same pace or even better in the next 1 year at a higher base.
Right. And what kind of dealer overlap do we see, in terms of tiles and bathware going ahead, and any SKU addition with respect to this? This
addition keeps happening quarter on quarter any which way. Recently, we did a launch with some new SKU additions in colored faucets and some other pieces of sanitary ware. As far as dealer overlap is concerned, well, 90% of the dealers stock sanitary ware like they stock tiles. But not all of our dealers are dealing with our sanitary ware. The current dealer overlap is approximately, if I'm not mistaken, I would want to get back to you, but what I remember last when I had asked them is I think about 600 dealers is an overlap which we have. So good headroom over there to convert other tile dealers who are loyal to us to sanitary ware.
Right. And Sumit sir, one bookkeeping question on gross debt and capex outlay for this year.
Yeah. So capex outlet I just mentioned, the balance amount of the capex of the Somany Max plant is something will happen during the course of the year. That plant we hope to start in August, September of this year, rather fire up in August, September of this year. And as far as the other capex is concerned, other than routine capex, we are looking at a proposal to set up a JV in Nepal, very early stages. A little more of that would be available for you in the next call. But yes, we are thinking of putting up a JV in the Nepal.
And gross debt numbers as on date.
Yeah. So gross debt number, Sailesh, I would let you answer this.
Consol numbers.
Console gross debt number today is 523 crores.
Okay. Thank you.
Thank you.
So,
So should we move on to the next question?
Yeah, go ahead.
Ladies and gentlemen, we will take the last three questions. The next question is from the line of Asim Bharde from DM Capital Advisors. Please go ahead.
Yeah, hi, good evening. Just wanted two clarifications. First, on the FY24 guidance, the mid-teen growth you talked about was volume, right? And value should be similar level, or would that come off despite the product mix improving?
so no, Ashim, it's just a clarification. The mid-teen growth was with respect to the overall growth, though it would be primarily driven by the volume, but that was for the overall number of growth.
Okay, got it. And I don't know if you mentioned it, but did you talk about FY23 volume growth? 9 months you have done 11%. Would be able to do the same or better for the entire FY23?
I think we have given a directional guidance. Let's keep it that for the time being.
Okay, sure. And just last clarification, what was the reason for higher financial cost in Q3? I missed that.
I think it was clarified earlier also. It was primarily on account of two. One, the increasing interest cost, whatever, increase, continuous increase happened, quarter on quarter over last 12 months. That would be broadly an external factor and linked with the repo rate, which is consistently going up. And second, the additional few debts which is coming in our two subsidiaries, two JVs with respect to the expansion. So these two things put together resulted in the additional finance cost Y on Y.
Okay, what was the gross debt number for 6-month period? You said 523 for 9 months. How much has that increased in Q3?
So Q3 is by and large intact. There is no major change in debt number as far as September versus December, but the finance cost which you are comparing is Y and Y. That was which is 1 year back. So there is additional.
QQ also there has been some increase, I think 2 odd crores, and I think it has increased from Q1 levels as well. So actually that was basically what I wanted to know.
So that's primarily because of the rising interest cost which is happening on every bi-monthly basis. So that's primarily because of that. Otherwise, gross debt number movement is not more than 20 crore rupees, September versus December.
Got it. Okay, thanks Sunit. Thanks everyone.
Thank you.
Thank you. The next question is from the line of Viraj Mehta from Equirus PMS. Please go ahead.
Sir, sorry, my questions have been answered. Thank you.
Thank you.
Thank you. The next question is from the line of Ritesh Shah from Investec. Please go ahead.
Sir, I just wanted to know your thoughts behind Nepal, if that's possible. That's one. And in notes to accounts, there is point number 5, which talks about board has approved 115 crores towards Somany Pescherel Private Limited. Yep, sir. If you can just explain these 2 points, that would be great, sir. Thank you.
So Nepal, we have a decent sale, and there's been a recent increase in duty in Nepal for Indian building material products, a lot of them. And tiles being a more voluminous product, we saw an opportunity to put up a small plant there. The market size is nothing very large, so therefore we will put a small plant, and we're looking at a decent market size going forward. And we are also exploring the possibility that 75-80% of the plant gets consumed in Nepal, and maybe 15-20% depending on how the plant is structured and what product we make. 15-20% of that plant can also come back to India and some border towns, but largely the plant will be focused towards Nepal. So that's the view which we took in Nepal. We are in exploratory stage. I think figuring out which product to put. Reasonably advanced stages as far as the other thing is concerned of identifying a land area, etc. So it's I will have a lot more data for you what we are doing in Nepal by the next call. So obviously we will be before that next call, but the next opportunity we will get to speak to you is in the next call. And the second question, I would like Sailesh to take that up, please.
So Somany Piastrale today, current structure of funding is that this company is fully funded by the holding company Somany Ceramics only. The current mix is a mix of debt and equity, where we have infused 115 crore of unsecured loans to the company. We had a relook at the funding of the company, and having regard to the current market scenario, we found it to be prudent to be funding it more through equity structure. So this 115 crore predominantly is for restructuring of the equity, the loan which is there. So this money will go, and a substantial part of this money will be used for repayment of the outstanding unsecured loans.
Sir, any specific trigger for us to revisit the capital structure for this particular entity?
So today the funding is 10 crores of equity and 115 crores of loan, right? We are putting additional 115 crores in investment in this company. Predominantly this 115 crore will be used repaying the 115 crore of unsecured loan.
Okay, but was there any specific trigger for us to do that?
The trigger was to basically make sure that, on one hand, you're servicing the, like he very rightly said, 100% of the loan was given by Somany, so there is no bank loan. So it was going from one pocket, coming to the other pocket. So the only reason for this was to give that particular SPV a little bit of a breather in a muted market and very high gas pricing.
Sure. This is helpful. Thank you so much.
Yeah.
Thank you very much. That was the last question in queue. As there are no further questions, I would now like to hand the conference over to Mr. Somany for the closing remarks. Thank you, and over to you, sir.
Thank you, ladies and gentlemen, for joining us for the Q3 FY23 earnings call. I hope that this quarter is slightly better and the volatility of gas and various other inflationary pressures hopefully are behind us or starting to taper off. We do believe in the India story, in the India growth story, so continuously putting in more capacity, and we'll continue to strive to do better margins and better sales. It's going to be a tough quarter, and it's also looking as a tough year ahead, but we are quite sure of doing a mid-teen overall growth, value and volume. So hoping for the best and look forward to an earnings call in May. Thank you so much.
Thank you very much. On behalf of SKP Securities Limited, that concludes the conference. Thank you for joining us. Ladies and gentlemen, you may now disconnect your lines.